Now I would like to draw your attention to three subtypes of financial statement level risks. And in some cases, individual risk factors may fall into two or more of these three categories, so you don't necessarily need to think of them as being mutually exclusive risk factors. The other thing I just want to mention is there may be financial statement level risks that have the potential to have a pervasive impact on the financial statements that don't fall into any one of these three subcategories. So I don't want to give you the impression that the financial statement level risks have to fall into one of these three subcategories. There may be some that aren't fraud risks or client business risks or strategic business risks. But generally speaking, many of the financial statement level risks that you will come across will fall into one or more of these three subcategories. But always keep in mind there may be some that fall in the other category but still have a pervasive impact on the statements. So the first subcategory I want to talk about is business risk. And sometimes I put the word strategic in front of it to distinguish this kind of business risk from client business risk, which is the next point, or auditor business risk, which I talk about on the next slide. So business risk or strategic business risk is a risk that the client won't achieve its objectives or execute its strategies, or it could be the risk that the client has set objectives and strategies that are inappropriate, don't make sense for the industry that the client operates in, are a little bit too extravagant or out of reach for them to have any reasonable chance of meeting. And there are many types of business risks that don't likely not have an impact on the financial statements. If they're not going to impact the financial statements, then we don't, as auditors, we don't really care about them. The only business risks we're interested in are ones that have the potential to impact the risk of material misstatement. So you may come across, in gaining knowledge of the client's business, you may come across strategic business risks that could harm the client's strategies or objectives, but will not have any impact on the financial statements. And so it's nice to know about those things, but we're not overly concerned about them as auditors. So as far as a couple of examples to illustrate this kind of risk, why don't we use RIM and its BlackBerry. So this is early 2012. And RIM's share of the smartphone market was upturned a few years ago when Apple jumped in with the iPhone, and right around the same time Google jumped in with its Android operating system. And these two major new competitors vastly disrupted the smartphone market that prior to that point RIM had been the leader, by far the leader in. And in the years since those new technologies were introduced into the smartphone market, RIM's fortunes have dropped precipitously because it has been unable to compete effectively with Android and the iPhone. So RIM went from having about 50% of the US smartphone market back in about 5 years ago, and the latest numbers that I've seen puts them with a share of about 5% of that market. So 90% of RIM's market share in the US has gone away because of their inability to come up with technology to compete with Apple and Android. So there's an example. The disruptive introduction of new technology from Apple and Google into the smartphone market dramatically hindered RIM's ability to achieve its objectives. An example of the second kind, risk from setting inappropriate objectives and strategies. Perhaps you promise, or your client promises to shareholders that it's going to achieve, let's say, a 30% return on investment every year for the next 5 years. When shareholders hold on, or new shareholders come in because of the promise of that high return on the investment. It's very difficult, except for high-flying companies in very successful industries, to achieve a 30% return on investment for 5 years running. So when investors see that you're unable to achieve that relatively extravagant objective, they may start to abandon your company. Your financial condition could deteriorate, and that could impact your ability to achieve your objectives and strategies. So there's a couple of examples of the two main categories of business risks that could have some impact on the risk of material misstatement. The next category is client business risk, which is the risk that the client's financial condition will deteriorate significantly, potentially jeopardizing the going concern assumption. A good example of this kind of risk would be a client who is on the verge of violating a debt covenant, drastically increasing the risk that its bank will or banks will call the loans that are outstanding, thereby jeopardizing their ability to continue as a going concern, or at least causing them to have to search around for new financing, likely at much higher interest rates. So any kind of risk that impacts a client's financial condition to such an extent that it throws its going concern assumption into doubt qualifies as a client business risk. And of course, anytime the going concern assumption is in doubt, that dramatically increases the risk of material misstatement, subsequently the audit risk of the engagement. So this is a very important risk to make sure you identify if it's present. Then the last subcategory is fraud risk, and you're probably all familiar with the fraud risk triangle, where we have incentives or pressures to perpetrate fraud. The opportunity exists within the client's internal control system to allow someone to act on that incentive or pressure, and the client personnel, some client personnel, have attitudes or are at least able to rationalize committing fraud in the first place. So anytime you've got a risk factor that creates an incentive or pressure, an opportunity, or you have client personnel with attitudes that are consistent with fraudulent behavior, then you have a fraud risk factor, which is more serious kind of risk factor for the auditor to be aware of than for something that doesn't necessarily create any problems from a fraud risk triangle perspective. An example of a fraud risk could be, say, a client who's had a public company client that's had a couple of bad quarters. They've missed the analyst earnings forecast and they're feeling pressure to get the stock price up and their earnings up. That could create a tremendous incentive or pressure for client management to engage in fraudulent activity to make sure they hit that next analyst earnings forecast, which would at least maintain or perhaps boost their stock price, elevating the value of their shares, their stock options, etc. Now I mentioned at the start of this slide that individual risk factors may fall into two or more of these categories. And just as an example, back in the client business risk discussion a couple of minutes ago, I mentioned the example that I mentioned was the client who was on the verge of violating a debt covenant, and that would drastically increase their client business risk. That kind of client business risk also could create an incentive for the client to engage in earnings management in an effort to improve the earnings, improve the debt covenants, and stay on side with the bank. So that single risk factor, being on the verge of violating a debt covenant, elevates client business risk, but it also elevates the fraud risk in the form of an increased incentive or pressure to engage in fraudulently misstating the financial statements. Similarly, if we go back to my example of RIM, it's at this stage in early 2012, it's certainly not on the verge of going bankrupt, but some analysts are becoming increasingly worried about RIM's ability to get out of the significant market decline it's been experiencing over the last couple of years. And so the strategic business risk related to their inability to come up with products that will effectively compete with Apple and Android may eventually put them in a situation where their financial condition starts to deteriorate. So there's an example of how a strategic business risk also creates a client business risk, and subsequently, as I mentioned earlier, most client business risks, given that it's putting the company's financial condition in jeopardy, will also create fraud risks. So there's an example of a single risk factor that could ultimately impact not only strategic business risk, but also client business risk and fraud risk as well. So when you identify a high level financial statement level risk that could have a pervasive impact on the financial statements, it can help to think about which one of these three categories it falls into, and also which one of the other two categories it may also impact as a result of the nature of the risk.